All right, we are live. Welcome to this week's Taxes and Retirement Live. Thank you for joining me. This week's topic will be the widow and widower tax penalty. And I'll discuss what that means in a second, but let me start with my dad jokes of the week. First, where did the peg leg pirate go for breakfast? IHOP, of course. Where else would he go? Want to hear a construction joke? I'm working on it. Get it? Working on it. Construction. Dad at joke. Dad at work. Fun fact, I do actually like to build things. In 2011, I was on HGTV's All-American Handyman, season 2. It was a reality TV show, a competition about building and fixing things. Mike Holmes was one of the hosts. Anyway, I was 4th place out of 20, so not too bad. But 4th place is really just 3rd place loser, I guess. I did not win. But I do like to build things, so Dad at work, my kids got me this a handful of years ago. It is appropriate and good for that joke. So, want to hear a construction joke? I'm working on it. And finally, did you hear about the invisible man who married an invisible woman? Their kids were nothing to look at either, because you can't see them. Got it? All right. So that's the dad jokes. Painfully good, painfully bad. Either way, it's good, I guess. As always, feel free to comment, drop questions along the way. This week's topic I don't think will be too long, so definitely chime in along the way as you see fit or as you have a question. So again, the topic is the widow/widower tax penalty. Now, admittedly, the word penalty is a little clickbaitish, but I use that because that's how I learned of the term, and it is still commonly referred to it that way. It's basically the gist of, and I'll walk through examples, but at a high level, it's the notion that when you're married and one spouse dies, the surviving spouse ends up ultimately having to pay more taxes at some point soon after the death of the first spouse. So as if it's not, hard enough mentally, emotionally to lose a spouse, and I've never been through it, so I can't pretend to know what it's like, but I imagine it's tremendously difficult. As if it's not bad enough to lose your life partner, there will likely also be financial, drawbacks and adverse impacts from the death, and that manifests itself in no other way, if in no other way than by higher taxes, which we'll walk through and I'll explain why. So it's not a penalty because the tax code is what it is. When you're single, you're taxed a different way than if you're married. That's it. It's not, again, not a penalty, but people who like to make juicy articles will call it a penalty. Because sort of the thought is if you're married, spouse dies, just let you keep the tax privileges of being married instead of taking that away from you. But anyway, so just want to say it's not really a penalty. You can view it that way, but it's just the tax code at work for what it's worth. So just stepping back briefly, when you're married and your spouse dies, you can still claim yourself as married filing jointly in the year of death, whether your spouse died January 1st or December 31st. In that year of death, you can still file as if you were married for the whole year when you do your tax return for that year. In subsequent years, you have to go back to filing as single, unless you eventually remarry, but assume you don't, or at least not immediately, you'll have to file as single. There are some exceptions. There's a filing status that you may not have heard of called qualifying widow or widower. That is basically if you're married and your spouse dies and you're caring for an eligible dependent. I forget all the rules and requirements around it, but it's effectively a child or some other relative or someone that is one of your dependents. You can stretch out the ability to file as married for 3 years, actually, the year of death plus 2 more years. That's qualifying widow or widower. But again, that presupposes or that requires you have some sort of, not some sort of, but you have a child or other dependent under your care. Assuming you don't, as is probably the case with most retirees, when your spouse dies, you get one last year to file as married. Every year after that, until you remarry. If you remarry, you'll have to file as single. So at a high level, there's really, let's say there's 2 reasons in the tax code why single people have to pay or end up paying higher tax once the spouse dies. First, and this week I'm going back to my good old-fashioned printouts on my clipboard. Part of the reason, let me get this centered here. is the way the standard deduction works. So at a high level, for those of you that don't know, your federal income tax is you take all of your taxable income, you subtract from that deductions. You can either take a standard deduction or itemized. After the Tax Cuts and Jobs Act went into place a few years ago, most people, especially married people, just take the standard now because it ends up being better in many cases. But point is, if you're married and filing joint return, your standard deduction, so right off the top, you can take $24,800 off of the rest of your income. And if you're 65 or older, add another $1,300 to that for each of the two of you that's actually 65 or older. So assuming you're both 65 or older, married couple, your standard deduction is going to be $27,400. So whatever your total income is, take that off of it, and then that's what you're ultimately taxed on. If you're single, these are 2020 figures, these change a little bit each year. If you're single, your base standard deduction is only $12,400, and then the additional amount, if you're 65 or older, is slightly more than 13, it's $1,650. So if you're single and 65 or older, your standard deduction now is $14,050. So look right here, right off the bat, if you're married versus single, you're saving, what is that, $1,300, $13,000, sorry. Your taxable income is $13,000 worse off by being single than it is married, all else equal. So that's one of the issues. I see we have, okay, so a couple people commented. Looks like the comments are working. Good. The other, there we go. Yeah, thank you, Cody, for adding some clarification about qualifying widower. All right. So the standard deduction is lower for single people than it is for married people. And then the tax brackets themselves are smaller. They're compressed. I won't get into the whole mechanics of how all these taxes are actually calculated and played out. Coincidentally, I did just post a video on my YouTube channel called like Overview of Federal Income Taxation or something that walks through this process. So if you're interested in learning more, go to YouTube, search up Retirement Planning Demystified, and you'll see one of the most recent videos was about this income tax overview. I've posted links in the Facebook group before to the YouTube channel, so if anyone's interested, go back and look, or just ask again, and I'm happy to post it up. But anyway, so you're married couple. Your first $0 to $19,000 in change of income is taxed at 10%, and then your next, from, let's round up and call it 20, from 20,000 to 80,000 in change is taxed at 12, and then beyond that 22, 24, 32, et cetera, et cetera. Don't get too hung up on the actual numbers. Just look, if you're single, these thresholds, these income thresholds for each of these respective tax amounts is cut in half. So your first, call it $20,000 if you're married, is taxed at 10%. If you're single, your first only $10,000 is taxed at 10%. And so all these brackets are cut in half, except this last one, this 37%. It's 622,000 and change if you're married, 518 if you're single. But otherwise, all these other ones, single people's income is taxed effectively twice as much, if you want to think about it that way, because all the brackets are, it's not entire, math doesn't work out that way, but the point is, these brackets are condensed and they're shortened, they're smaller for single folks. So when you're married, you have the benefit of that larger standard deduction. Again, so assuming you're 65 or older, it's $27,000 in change. So right off the bat, you're reducing your taxable income by a bigger chunk for being married than if you were single. And then the actual tax rate that applies to your taxable income is going to be ultimately higher because your brackets of income are smaller if you're single than if you're married. Cool? Well, not cool. I mean, it's not good, but it is what it is. So that's sort of the reason why it exists. And then other things that may make it even worse, as we've talked about in the group before, the other sort of stealth or hidden taxes in retirement. So this is just like, what I walked through, the standard deduction and tax brackets. That's just the base template of your federal income tax. There's also other things like those Medicare IRMA premium surcharges. Those are a stealth tax that the thresholds of income are also cut in half for single people versus married people. So for married, if you have $174,000 of gross income or less, you don't pay any extra Medicare premium. If you're single, it's $87,000 of gross income or less. You don't pay extra. So those brackets, those thresholds are condensed as well for single people. So you go from being married, spouse dies, unfortunately, you're now single, your tax rates are higher, your standard deduction is lower. You may now get triggered into these other stealth taxes like Medicare premiums. Potentially more of your Social Security gets pulled into taxation, because how much of your Social Security is taxed is also a function of how much other gross income you have. So all those things could come into play as well, which could mean like a real doozy of extra tax for a recent widow. Now, to put some numbers to it, show an actual example. Granted, I manufactured this example to really show and highlight this widower tax penalty at its worst, but I don't think this scenario that I came up with is too far off from a realistic scenario in the real world. Could be better, could be worse, but I think this is what I'm about to show you is actually a fairly reasonable and respectable sample case. So it's a hypothetical couple. We will call them Jack and Diane. A little ditty about Jack and Diane. Two American kids doing the best they can. Yes, that's John Cougar Mellencamp. But yeah, so Jack and Diane, we'll assume Jack's 75, Diane is 72, just for the fun of it. The other assumption is we'll assume Jack was the higher breadwinner. Diane didn't work outside the home until, we'll call it, the last 10 years. So she didn't build up as much, didn't make as much money, didn't save as much 401k, also didn't accrue as much Social Security. So just as a sample or an example, and I got some real high-tech AV stuff here with little pieces of paper. I'm going to flip and show you things. So here's the base case. So Jack and Diane are currently married. This is 2020. Sorry, a little dark here. Here's their sources of income. Jack, he has $30,000 a year Social Security coming in. Diane, she has 18. Let's say Jack has a pension, $30,000 a year. RMDs, required minimum distribution. So we'll assume Jack has a $600,000 IRA. He's age 75, so his required minimum distribution is going to be about $26,400. And then I won't get into that math. We've discussed that separately, so just that figure is what it is. That's the minimum amount Jack has to take out in the year of 75. Same concept for Diane. Diane has an IRA worth about $100,000. She's age 72. Her required minimum distributions just under $4,000. All these total incomes are a little over $108,000, and under current 2020 married tax rates and so forth, their total tax on this $108,000 of income is $8,384, which is an effective tax rate of 7.7. Now, technically effective tax rates are like the tax divided by the taxable income, but just for purposes of demonstration, I'm just showing this tax relative to this total gross amount of income is 7.7%, right? So again, I came up with these numbers. I manufactured this scenario to really try to show this widower tax penalty at its worst, but I don't think this is a horrible set of assumptions right here. Next, and this is where the magic really happens with this top-notch artwork here. So let's assume now Jack dies. Let me move my fingers. So Jack dies. What happens to the income? So Jack's Social Security technically goes away. Well, let me rephrase that. The way Social Security works, and I'm going to be discussing this in a live session in October. I just added to the calendar yesterday. When there's a married couple and one spouse dies, the surviving spouse lives on, keeps on with the higher of the two payments. So whatever the spouse who died was getting at his or her death, or whatever their surviving spouse was currently getting, the higher of those two lives on, the smaller goes away. There's more to it behind the scenes, but just assume that. The higher survives, the lower goes away. So because Jack was getting $30,000 Social Security, Diane was getting 18, when Jack dies, that 18 goes away, and the $30,000 lives on for Diane. So here we go. So Jack died, his Social Security's gone, but the 30 he was getting ends up going to Diane as a survivor benefit. Let's also assume that the pension Jack had, he was wise and thoughtful of his spouse when he selected the payment type, and he selected a payment type that would live on in 100% to Diane if he predeceased her. Typically with pensions you have an option. You can take a payment that lasts only for your life. You can take a payment that will last 100% for you or your spouse's life. It doesn't matter who dies first. You can also do stuff in between sometimes, like a 50% will live on to your spouse, or 75%. So we'll assume Jack selected a 100% lives on to Diane. So Jack died, his 30,000 pension. Diane continues to get after Jack died. Jack's IRA basically went away, so there is no required minimum distribution from it. But what happened was his 600,000 IRA was Diane inherited it. She put it in her own account. So in addition to the 100,000 she had, she added Jack's 100,000 to it. So now basically Diane has a $700,000 IRA. Again, assume she's 72. Her required minimum distribution on that 700,000 will now be about $27,000. You can see where I'm going with this. Total income dropped about $20,000 from 108 to 87,300. Look what happened to the tax though. Tax went up from $8,300 and change to almost $11,000, which is an effective rate of 12.6% versus it was only 7.7. So double doozy. Not only does, look at this magic, this is top-notch stuff here. Not only does Diane now have $21,000 less of income, but she has $2,600 more of taxes. That, my friends, is the widower tax penalty. Got it? If you have any questions about the assumptions and what all I did here, let me know. I thought this was a pretty clean scenario and fairly realistic. So as if it's not bad enough that income goes down and taxes go up, think about expenses. This is outside of taxes. This is just other sort of general life stuff. Upon your spouse dying, your expenses may not go down as much as you would think, or as much as your income dropped, because there'll be some less food and discretionary and clothing expenses, and some less healthcare expenses. But assuming you stay in the same house, your mortgage or rent or utilities or maintenance don't go away. Property taxes don't go away. Transportation gets reduced, negligibly. Maybe you sell a car or whatever. The point is, the reduction in your overall living expenses may not go down as much as the reduction in your income, which isn't a good pairing. And slap on top of that now, taxes are almost certainly going to go up, unfortunately. That is the widower tax penalty. That's at the federal level. State level, probably not drastically different. Again, there's 50 states in the country. Not all of them have income tax, but for those that do, their tax structures and tax processes are slightly different, but generally they're going to loosely follow something like the federal structure. So in addition to your federal tax going up, it's fairly safe to assume your state tax will go up as well, assuming you're not in Texas, or you're not in a state that doesn't have income tax. So what can you do about it? That's a good question. Frankly, there's not a tremendous amount. Be aware of it. Know that it can and will happen. Whenever you do retirement planning or making any sort of financial decision, whether it's claiming Social Security, which is why trying to maximize one of your benefits is good, because it provides the larger survivor benefit. But whether it's claiming Social Security, claiming a pension, planning for required minimum distributions, any sort of financial planning for retirement, you need to factor in what's going to happen if and when one of us dies, because chances are, you're probably not both going to die at the same time. So one of you will be the surviving spouse and therefore subject to the widower tax penalty. So now that you know what it is, just be aware of it, build it into your plans and your assumptions that one of you is probably going to outlive the other, and then what's going to happen to your finances, and will you be okay? Can you be okay? There's some ways to sort of get ahead of it, which is kind of like the overarching theme of most of what we discuss in taxes and retirement, is if you can reduce the sources of taxable income that you have and that your surviving spouse will have. One of the ways, ding, 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 no surprise, is to potentially have more of your money in like Roth accounts that'll come out tax-free and get inherited tax-free than regular taxable accounts. Because part of the reason why your income may not drop so much upon the death of a spouse is because the surviving spouse usually inherits the IRAs or 401ks or any other investment accounts from the deceased spouse. And the surviving spouse just makes those accounts his or her own. So the total amount of investable assets doesn't really decrease much, if at all, upon the death of a spouse, which means therefore the required minimum distributions on that collective pot of money won't decrease much, if at all, depending who's younger, who's older when the first spouse dies. But this RMD amount, Diane may be getting stuffed with larger RMDs than she wants or needs, which is part of the reason that's driving up this tax bill, because these RMDs are all taxable income when you're pulling them out of a tax-deferred account like an IRA. If instead the majority or a good chunk of the money was in Roth accounts instead of tax-deferred accounts, the RMD hit, well, there wouldn't be an RMD from a Roth account in Diane's hands, and any money she does take out won't be taxable. So that could help with the sting of the widower tax penalty. How else can you manage it? Well, like I said, try to get ahead of it if you can. Roth accounts are one decent idea. And like all things we discussed in this group, don't let this what I'm calling penalty in this widower tax situation, scare you into thinking, oh my God, I need to rejigger my whole finances, whatever. Most of the stuff in the group, live your life. Yes, this stuff is important, and to the extent you can take advantage of these opportunities and what you're learning here to make your retirement easier, or make your money last longer, or just simply let you stick it to the man some and pay less tax in your retirement years, great. But you don't necessarily have to obsess over this and lose sleep and let this be the end all be all of life, as, oh my God, I need to shave off every single future penny of tax I possibly can. If that takes away from your enjoyment and quality of life in retirement, then don't do it, right? Some people may just be like I discussed last week, I think, I don't want to bother, whether it's too much work or I just don't care or whatever. I just want to spend my money, live my life, and enjoy myself. Fine, so be it. So you don't necessarily have to stress over this. My purpose with this group and today's topic is just to make you aware, to let you know what's out there, things to consider. Hopefully you're all gaining a little something from it and realizing, oh yeah, I didn't know that. Let me consider that, or it won't be too painful to implement this, and it could potentially, do me good over the long term. Stuff like that. So I don't want to scare you with this topic. That's not my intention. I just want to make you aware of it. If it is something that you are concerned about and want to try to manage around or help find planning opportunities, whatever, and you're not willing or able or just simply don't want to do it, there are people who'd be happy to help. Delegate, like any financial planning aspect of your life. If you want to delegate, find someone who's versed in it and can help you do it, not just someone who's looking to gather your assets, charge you a percent on it, and manage your investments. Someone who actually is wanting and willing and knows how to plan and get ahead of tax stuff like this. Or, again, simply do it yourself if you're willing and able and care enough to do it. All right. That's all I had, honestly. So where are we at? We're at 8:24. Fairly short. I am done with my spiel on the widower tax penalty. If anyone else has any questions about this or about any other topics for that matter, feel free to drop them in the comments here. David Fultz, taxes may also be higher beginning in 2026. Yes, not may also, will also. So that's fact. That's legislative fact. Tax Cuts and Jobs Act went into effect. Most of it went into effect in 2018. The current federal tax structure we're in now, this is the Tax Cuts and Jobs Act we're living in. It is already pre-built into the tax legislation that these current low rates will expire, aka sunset, at the end or starting in 2026, at which point the rates will go back to what they were prior to changing in 2018. So it depends on the bracket, but they're all going up 2, 3, potentially 4%. I forget the exact amount. So 24% tax bracket is really getting hurt the most, going back to a mix of, I think, 28 and 30 something, if I remember correctly. So yes, David, good point. Taxes will go higher 2026, maybe even sooner. Again, not to make things political, but depending how the election goes and how the composition of the House and Senate do or don't change between now and 2026, it's quite possible that rates increase faster than then. Good point, thank you. Tommy, can you comment at all about head of household? I believe it's an option for someone I'm helping who has a minor grandchild who lives in the home for more than 6 months per year. Anything in particular worth being aware of? Yes. I don't remember all the specifics, but head of household is another filing status. It's loosely comparable to qualifying widow-widower. Qualifying widow-widower only comes into play if you're currently married, one spouse dies, the surviving spouse, if you have a qualifying dependent or child, can continue using the married tax brackets for the year of death plus 2 years thereafter, I think. Head of household, you don't need to be married. In fact, it's actually not, I don't know if you're allowed to even use it if you're married. I don't think you are. But basically, head of household is someone who's single and has a qualifying dependent. I don't remember all the rules, whether it's child, relative, some other person that's dependent on you. So yes, a grandparent taking care of a minor grandchild. You say 6 months, which is good. I think one of them is the child or the dependent needs to live in the home at least 6 months. You need to provide at least half their support. And there's a host of other things that that you need to meet to qualify. But what head of household gets you is it gets you a larger standard deduction. So I forget what it is. So single is $12,400 this year. Married is $24,800. Head of household's in between. It's like $18,650 perhaps or thereabouts. The tax brackets are also kind of in between. So head of household gets, it's rough, not quite, but it's like 1.5 times larger than what the single brackets are, not quite twice as large as which is what the married brackets are. I'll leave it at that, Tommy. I'd have to look it up. I know there's lots of little conditions and things you need to meet to qualify, but yes, it's quite possible whoever you're talking about could qualify for head of household, which would be better than single. Good. Cody, good reminder that income needs don't perfectly cut in half when a spouse dies. Yes, they usually go down somewhat, but not, I'd say probably rarely in half. Ken Michael, would this be a good reason to have a life insurance policy? Depends. It could be one of the reasons to have a life insurance policy. It depends what your financial situation's like. So there comes a point in life where the risk isn't dying too soon, it's living too long, to be blunt. When you're 20, 30, 40, 50 and you have spouse, house, kids, everyone's financially dependent on you to some extent, that's exactly where life insurance comes in. If your loss of life would lead to a financial hardship for anybody, life insurance, that's the answer, boom. Now I won't get into what type of life insurance, term versus whole life versus whatever, that's a whole other topic. But yes, that's when you would want life insurance. But there comes a point in life, kids move out, house is paid off, college paid for, there's no other major life expenses other than your normal living expenses. But let's say you got a Social Security, you got pension, maybe you have a few $100,000, if not $1 million or $2 million of money saved up, and chances are you're not going to outlive it. Even if you die and your spouse lives on, if there's not a high risk of you outliving your money, then you don't need life insurance. Like I said, there comes a point in life where the risk isn't dying too soon, it starts becoming living too long. And by that I mean people who do get older in age, live to 80, 90 or beyond, and run a risk of outliving their assets. You don't need life insurance, you need an annuity at that point. Annuity is something that's going to provide ongoing income for the rest of your life. If you think about it, an annuity is sort of the inverse of life insurance. Life insurance pays you if you die early. Annuity effectively pays you if you live long. And that's why, not coincidentally, they're both sold by insurance companies. One is the opposite risk and payout profile of the other. So insurance companies sell annuities to sort of hedge their insurance risk and vice versa. Not to get too off track, but maybe you'd still need life insurance. If you're 70, 80 years old, most people probably don't need life insurance. If you do have it, it may be prohibitively expensive, if even possible at all, to get at that age. Or if you already have a whole life policy or something else, or you've been paying in a long time, maybe it's worth keeping it, but it's also probably not going to be cheap, thousands of dollars a year, depending how much coverage you have or want to maintain. So it all depends, Ken. Good question, but I wouldn't say it's a slam dunk to say, yes, keep life insurance because of this. It's all going to depend on the rest of your financial facts and circumstances for you and your spouse. But good question, though. Okay. So Cody, yes, Cody posted a link. Thank you for that. I can't see what it is, but I assume it is about head of household, perhaps. Yeah. Okay. All right. That's all I have. It looks like that is it for the questions. So short and sweet this week. It looks like I will be on August 19th, I think it is, having a special guest. I think I may have gave a bit of a spoiler in prior weeks, but hopefully it's going to be Jim Saulnier of Jim Saulnier and Associates. He's the one who has that podcast, the Retirement and IRA Show, that I mentioned last week. Absolutely phenomenal podcast, super, super great education. He's been around, his practice has been around the better part of 20 years. His podcast has been around, I think, more than 10. It started as a local radio show in Fort Collins, Colorado, where he's based. And at some point along the way, it transitioned over to podcast. So the podcast has been around at least 4 or 5 years, but him having a show has been 10 years or more. So he may come on August 19th. It's looking pretty good at this point. Not confirmed, but hopefully. So that should be really cool. We're going to do like a co-host thing where we're probably going to talk about like the top handful of things that he sees the top tax and retirement mistakes, people make, or that he's seen people make in his 20 years of doing this. So hopefully that works out, fingers crossed. And that again, August 19th, most likely. Another question here. Carol, what about long-term care insurance? Yes, good one. That's a tough one. Probably not the answer you wanted to hear, but long-term care insurance is quite expensive, and anyone who's been looking into it or following it knows that when it first came out 20-ish years ago or whatever it was, the insurance industry grossly underpriced it. They underestimated how many people would actually be making claims and how long those claims would last. And I think just even the absolute cost of insurance, the cost of providing care, that they may have underestimated. So the point is, people have had policies they've been paying for however many years, and then they get these like really big increases to their policies. There's no, I think in most, if not all cases, there's no like cap on how much you're going to pay. Or if there is a cap, then they're just going to take away how much benefits you're going to give you, because over time this stuff continues to go up in price. So is it worth it? Again, it depends on your situation. So my basic view is, if you're single, unless you have plans to leave a large pot of money to people or charities or whatever, you may just want to wing it. And if and when you have a long-term care event, just spend down your assets. Eventually Medicaid will kick in, and let them pay for it. You basically have to blow through everything you own. I think you can keep your house and I forget the number. It's some trivial amount of money, like $12,000 or something. But outside of that, you have to burn through everything you own, paying for your own long-term care. Then Medicaid kicks in. That's one way. That's called self-insurance. It doesn't sound glamorous on the surface, but again, if you really have nothing to insure, you don't have goals of leaving your money to other people, or there's no spouse to have to consider, I don't know if it's needed. Now, it's not to say don't get it. Maybe your concern is, well, Medicaid in my state is stingy and they're not going to let me or afford me the ability to get into a respectable place if and when I need long-term care. So I'd rather pay the thousands of dollars per year now to get a policy to hopefully, if I need it, to get myself in a facility I want to be in. Maybe then you consider it, but it's a really personal decision. For married couples, this is where the analysis starts to change. Again, it all depends, but I feel like if your assets are small enough, maybe you just self-insure, and if you do have a long-term care event, spend down your assets, go on Medicaid. If your assets are large enough, let's just say a couple million or more, and this isn't exact science, it's just me picking a number, you may have enough money to self-insure, because I forget the statistics, but the average person on long-term care is on it for, I'm making this number up, it's like 1 to 2 years or something like that, maybe even less. Some people are more, that are on it for 5 to 10 years and unfortunately die there. But a lot of people are in long-term care fairly short-term, then back home. Not that they're back to 100% mobility or whatever, but they're off of formal long-term care. So if you're a married couple, you have a couple $1,000,000 or more, it's not a bad idea just to maybe self-insure. Because even if it's 100 grand a year for 5 years, that's $500,000. If you have enough nest egg to cover that, maybe go ahead and do that. If you're super conservative, if you have reason to believe or family history that you may be more prone to a long-term care event where you're going to need insurance, maybe start considering it. Also keep in mind, Sean is saying, what about a long-term care, I'm sorry, Cody, long-term care show. Good idea. I'm not an expert on this. I know enough to know what to think about, but I don't know that I can fill up a whole hour about this. So forgive me if I'm getting a little off topic from widower tax penalty, but it looks like this is a topic people are concerned about. So I'll discuss it tonight. Where was I? Right. So if you can self-insure, maybe you do that. Also keep in mind that most of these policies have what's called an elimination period, meaning they won't pay until you're in long-term care for often 90 days. So the first 3 months you're paying anyway. If you want to shorten that elimination period to like 30 days, you can, but guess what? You're going to be paying more in premiums. So it's always like you pay for what you get. Or if you lengthen out the elimination period to 6 months, your premium is going to be lower, but guess what? You're paying out of pocket those first 6 months of long-term care. So there's lots of things to consider in shopping for long-term care. Maybe it's worth it, maybe it's not. Where I think it starts to be worth it more so is married couples where you don't have $2,000,000, but you have like $1,000,000-ish. Enough that you don't really want to burn through it, but not so much that you can safely self-insure multiple years of a long-term care event. Then you want to start considering it some more. Even then, it's not a slam dunk decision. There are some hybrid products, and I'm not an insurance expert, so I'm getting a little ahead of my skis here, but there's some hybrid products where you can get like a whole life insurance policy that also has the ability to pay or convert to long-term care insurance, so that you have some life insurance. And part of the reason people don't like life insurance is, well, maybe I don't need it, or what if I die so long in the future that I don't really, I'm not financially, no one's financially dependent on me, so I don't really need this policy. Well, you can get life insurance that down the road you can convert to long-term care and use it to pay for some long-term care. I like that in principle, that those hybrid policies. I'm not an expert. I haven't researched them enough to know which specific policies are good or bad or why. But that's one thing to consider if you are shopping for long-term care, is look for something that has a hybrid feature to it. One other thing to keep in mind with long-term care, it's not just simply like, I don't know, I fell and my hip is bruised, so I need someone to come to my house and take care of me for a while. The formal definition is you need to not be able to do 2 of 6 activities of daily living. And these are basic things: feeding yourself, getting out of bed, dressing yourself, using the restroom, forgetting the other 2, but very basic primary functions of life. You need to be able to not do 2 of them to qualify for long-term care. So simply not being able to feed yourself isn't enough. You have to also have one of these other ones, like you can't get out of bed, you can't dress yourself, you can't get on and off the toilet and wipe yourself. 2 of those things need to happen. So it's a pretty, long-term care is like a real severe thing. It's not just, I don't feel well, I want someone to come help me. It's like, you struggle to function with daily life. Just food for thought. So long-term care is like really, you're really hard off. It's not just, I don't feel well. So you got to try to kind of guess, like, what's the likelihood of me having an event in life so severe that I can't do 2 of those 6 activities of daily life. All right, I rambled enough about long-term care. That was kind of a long-winded way to say, I don't know, Carol, whether or not you should or shouldn't consider long-term care. If nothing else, maybe shop around, get some prices for policies just to know what you're working with, and have the figures in hand, and then start to decide, is it worth the cost-benefit analysis, etc. Shook, what if Social Security and Medicaid will be broke? Yeah, what if? Good point. Tough to say. So Social Security. Okay. Social Security is its own pot of money. There's also a separate Medicare pot. They're kind of collectively viewed as the same thing, but there's ways the government can increase that. They can force people to pay more tax in. So I'm not that concerned with Social Security or Medicare ever really going broke, because the government can simply jack up payroll taxes, and there's infinite number of changes that could be made, some subtle, some not, to help bolster the finances of these things. It takes a lot of political capital and gusto to put yourself out there and make these changes, but nonetheless, the changes will happen, albeit probably at the 11th hour. So I'm not that concerned about Social Security and Medicaid going bust. Also, Medicaid is partly funded by the states. It's a joint state and federal venture. Now, granted, all budgets are kind of busted right now because of the pandemic. So that sort of heightens this concern of how and when and what will happen if and when these government pots of money run out. I'm not sure, but there are levers that can be pulled to help strengthen stuff somewhat, at least. Self-insured may be good if younger you buy into. Yes, so I guess the question is, the younger you are, the cheaper it is in premium. Yes, so maybe that makes more sense, but that also means that's a longer period of time you're paying premium, which is why the premium is cheaper. I forget the number, but something like once you hit about 60-ish, it's you either can't get approved for a policy because you're already so close to potentially needing it, statistically speaking, or it's going to be so prohibitively expensive it's not going to be worth it. So from what I gather, early 50s is kind of the sweet spot to seriously consider long-term care. Earlier than that, it's probably too young to buy it because you'll be paying premiums for a long time and not likely need it. Later than that, it may be hard or too expensive to do. David, bathing. Yes, bathing is one of the 6 activities of daily living. Thank you. And finally, Cody, I'll post a long-term care summary I have on hand if not discussed in a future show. Great recommendation, Cody. Go ahead and do that, because I don't know that I want to tackle this. I may at some point. I'll need to do a lot of research and brushing up and educating myself more on long-term care before I do that. So don't anticipate me doing a show about this in the next few months at least. All right. Looks like that's it for the questions. If anyone else has anything to say, shoot now. If you ever hold your peace, there is about a 20-second delay on these questions for me to see them. I will take a sip because I'm parched, and give it a few seconds to see if there's any other comments. Looks like there's not. All right, so we will wrap it there. Thank you all for today, and I will see you again next week. Next week I'm really looking forward to. I think next week is a discussion of fees involved in financial products and advice you get. Now that one has nothing to do with taxes, but that is a topic I'm very passionate about. You know, I am a living, breathing financial planner / investment manager. I have a very unique fee structure. I think it's unique and a lot more fair than what most of the industry charges. So I'm passionate about this fee discussion. I think fees are unnecessarily high in many products and in many types of advisory relationships. So I'm going to be discussing next week all the things to look out for so you can know what fees you're paying in your annuities, in your mutual funds, in your ETFs, in your brokers, in your advisors, in your insurance products, etc. So definitely gonna want to tune in for next week. That's going to be a fun one. Until then, have a good week, and I will see you next time. Take care.